It's January 2019. A company is preparing to go public. Its valuation, $47 billion. More than many major publicly traded transportation and industrial companies at the time. Investors are circling. Banks are competing aggressively for a role in the IPO. The founder is appearing on magazine covers, being compared, seriously, in print, to some of the biggest names in modern technology. 11 months later, that same company faces a dramatically different reality. The IPO collapses. Leadership changes follow. The founder departs with a package that publicly reported figures later placed at roughly $1.7 billion as part of a restructuring. And a valuation that once appeared unstoppable falls dramatically. This is the story of one of the fastest-growing workspace startups of its era. And this isn't simply a story about a struggling business. It's a story about how an entire financial ecosystem, banks, venture investors, institutional money, and market incentives, placed extraordinary confidence in a company that would later face intense public scrutiny. Here's what we're going to do today. We're going to perform a full autopsy on one of the most ambitious startup stories of the 2010s. Not to mock it, not to oversimplify it, and not to reduce everything to one founder, but to understand the mechanism of how something like this happens. Because outcomes like this rarely appear out of nowhere. They follow patterns. Specific, repeatable patterns that show up across financial history again and again. By the end of this video, you're going to understand 3 things that many people, even people working in finance, still debate about this story. First, why many critics later argued this company's economics looked far closer to commercial real estate than software. And why that distinction mattered more than almost anyone realized. Second, why the valuation may have appeared rational to sophisticated investors at the time, even if many observers later questioned it. And third, why the most important lesson here isn't about one startup at all. It's about a pattern of thinking that shows up repeatedly in markets, and how to recognize it before momentum starts replacing analysis. Stay with me, because this story changes the way many people see markets. Let's start at the foundation, because this is where everything else comes from. The company's actual business model, stripped of the branding, the premium coffee, the motivational slogans, and the curated atmosphere, was relatively straightforward. Lease large commercial office spaces long-term, divide them into smaller offices, and rent those spaces to startups, freelancers, and growing businesses at a premium. That's it. That's the business. Now, if I described that model to you without the branding, if I simply said, here's a flexible office leasing company, what multiple would you value it at? Probably somewhere closer to commercial real estate businesses. Maybe 1 to 2 times revenue. Maybe more in optimistic conditions. Established commercial property and workplace service businesses have historically traded on very different economics than software companies. Yet at its peak, this company was reportedly valued at roughly 18 times revenue. Not earnings. Revenue. Despite continuing losses during periods of aggressive expansion. So how does a workspace company end up being valued more like a software business? The answer is a word that shaped much of the 2010s investment environment. Tech. The company didn't simply describe itself as office space. According to marketing materials and public filings, leadership positioned it as something larger. A technology platform. A community business. A physical social network. Public materials reportedly framed the mission in unusually ambitious terms centered around reshaping how people work and connect. And according to widely covered interviews, the founder often spoke about extremely large long-term ambitions for the company. Now this part matters. Because during the mid to late 2010s, technology companies and real estate businesses were often valued by entirely different rules. Software businesses could sometimes justify very high revenue multiples. Why? Because software scales efficiently. Once code exists, adding more customers may involve relatively low marginal cost. Real estate works differently. Every new location often means new leases, new renovations, new operational spending, new staffing. Growth becomes expensive. And in this company's case, costs reportedly grew rapidly alongside revenue. When the company eventually filed paperwork for its IPO in 2019, public investors received a closer look at the finances. According to filings and reporting from the period, revenue growth was substantial. But operating losses were substantial too. Public documents also highlighted significant long-term lease obligations, commitments that would continue regardless of short-term business performance. Critics questioned whether shorter-term memberships could consistently support long-term obligations during periods of weaker demand. Supporters believed scale and brand strength could eventually improve the economics. And importantly, much of this information wasn't hidden. The details later debated publicly appeared in filings, reporting, and investor discussions. Which raises the question that actually matters. If many of these concerns were visible, why did some of the most sophisticated investors in the world continue backing the company so aggressively? That question takes us to the next layer of the story. Why smart people still believed. Here's the counterintuitive angle. And I want you to hold it carefully because it's easy to misread. The investors backing this company were not, mostly, inexperienced. Several major institutions reportedly invested billions of dollars across multiple rounds. The people involved had access to financial models, analysts, due diligence teams, and far more information than outsiders ever saw. These were sophisticated participants. So why did confidence remain so high? One explanation offered by some market observers comes down to something we might call narrative momentum. Here's how it works. When a story becomes compelling enough, when the vision feels large enough, exciting enough, and emotionally persuasive enough, it can begin shaping how people interpret risk. Losses may start looking like investment. Aggressive spending can appear ambitious. Complexity may feel visionary rather than concerning. The story doesn't replace the numbers. It reframes them. And this pattern is not unique. Observers have pointed to similar dynamics across financial history. Different industries. Different decades. Different narratives. But often, remarkably similar psychology. And according to multiple published accounts, the founder was widely described as charismatic, persuasive, and unusually effective at communicating long-term vision. Journalists, investors, and former employees frequently described a leadership style built around ambition and confidence at enormous scale. Several reported accounts suggested people often left meetings energized, feeling like they were participating in something unusually significant. That dynamic matters. Because conviction can feel persuasive. Especially when reinforced by momentum, media attention, investor confidence, and rapid growth. And here's where things become even more interesting. Some analysts later argued that for a period of time, the valuation itself may have partially reinforced belief in the company. When major investors publicly support a company at very high valuations, perception changes. Talent becomes easier to recruit. Customers feel confidence. Partners negotiate differently. Expansion accelerates. The valuation begins shaping the reality around it. Until it doesn't anymore. And arithmetic tends to invite closer scrutiny. When the company filed public offering documents in 2019, it wasn't simply presenting information to enthusiastic private investors anymore. It was opening the books to institutional investors, analysts, journalists, and public market participants whose job was to examine assumptions carefully. And as reporting from the period shows, scrutiny intensified quickly. Revenue growth remained significant. But so did losses. Long-term lease obligations became a major focus. Governance structures attracted increasing attention. According to public filings and reporting, the founder retained unusually strong voting control through a dual-class share structure. Supporters argued founder control can preserve long-term vision. Critics questioned whether accountability mechanisms were sufficiently balanced. Public reporting also discussed related party arrangements disclosed through company materials. And within weeks, sentiment began shifting. The IPO was postponed, then withdrawn. Leadership changes followed. The founder stepped away from the CEO role. Reports suggested valuation expectations declined sharply, and the conversation surrounding the company changed dramatically. The question was no longer, how big can this become? It became, can the underlying business realistically support expectations at this scale? Most financial education focuses on numbers. Revenue growth, margins, debt, cash flow, valuation. And those things matter. But stories like this reveal something equally important: the structure surrounding an opportunity can matter just as much as the numbers. Because behind many major business reversals sit recurring patterns. And whether you're looking at a startup, an investment, or even a career opportunity, these patterns tend to repeat. Trap 1: the reframing of losses as investment. This one is subtle, because sometimes it turns out to be true. Many successful businesses prioritized growth over short-term profitability. Amazon is a common example. For years, it reinvested aggressively into expansion. Eventually, scale strengthened the economics. So when companies say, "We're investing today for larger returns tomorrow," that can be reasonable. The important question becomes, does the business improve as it scales? Or do costs rise alongside growth? Supporters believed scale could eventually strengthen this company. Critics questioned whether expansion costs were increasing faster than the underlying economics improved. That distinction matters, because growth alone does not guarantee durability. Whenever future profitability becomes the explanation for present losses, ask, what specifically changes later that improves the math? If the answer remains vague, pay attention to the vagueness. Trap 2: complexity as camouflage. Large businesses are often genuinely complex. Multiple subsidiaries, different markets, various financing structures. That part is normal. But complexity can also make analysis harder. Public reporting during the IPO process increasingly focused on governance structures, voting arrangements, and organizational complexity. Supporters argued founder control supported long-term strategy. Critics questioned whether accountability mechanisms were sufficiently balanced. The lesson here isn't, complexity automatically means something is wrong. It doesn't. The lesson is simpler. If something becomes difficult to explain clearly, slow down and understand why. A useful principle: if you cannot explain how a business makes money in 2 or 3 sentences, spend more time understanding it before making a major decision. Trap 3: social proof as substitute for analysis. One reason confidence around the company grew so quickly involved the institutions surrounding it. Major investment firms participated. Large banks competed for involvement. Recognizable names increased credibility. This creates something psychologists sometimes call social proof. The logic sounds familiar. If sophisticated people believe in this, they probably know something I don't. And sometimes that turns out to be true. But incentives vary. Banks may benefit from transactions. Investors may benefit from rising valuations. Employees may prioritize opportunity. Different participants can view the same company through different incentives. Other people's confidence can be useful information. But it is not the same thing as independent analysis. History contains many examples where broad confidence later shifted dramatically. Not necessarily because people acted irrationally, but because expectations changed. Trap 4: the urgency of missing out. Momentum changes behavior. When stories move quickly, urgency grows. Opportunities begin feeling scarce. And under pressure, careful analysis often becomes compressed. Some reporting from the company's fundraising period described unusually strong excitement around its future potential. For employees, investors, and stakeholders, momentum can feel persuasive. But urgency rarely improves decision-making. A useful principle: when something feels too urgent to evaluate carefully, slowing down may sometimes be the smarter decision. Because long-term opportunities usually remain understandable after thoughtful analysis. And one of the more interesting ironies in stories like this is, getting in often feels urgent. Getting out can become much harder. The playbook. What you can actually do with this. Okay. So we've performed the autopsy. We've looked at the rise, the valuation, the funding, the business model, and the reversal. Now let's talk about what you actually do with